Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we bring in someone interesting, a minister, a CEO, someone who's got something to say about things we care about, the economy, interest rates, property, and none better today than David Whitburn. Welcome to interest.co.nz. David is the president of the Auckland Property Investors Association. And today, David, we want to talk about what's happening with rents and rental property in Auckland. You're a rental property owner yourself.
Yes.
What are you seeing with rents in Auckland?
Sure, seeing that rents in Auckland are rising. They're rising for a number of reasons, and they're rising at non-uniform rates across our region. They're rising quite sharply, in particular in some of the central Auckland suburbs. The suburbs, say, for example, around here in Herne Bay, Ponsonby, Grey Lynn, those very desirable areas because people want to be near the CBD a lot faster than other areas.
And what sort of increases in rents are you seeing?
They've actually been quite sharp. I was on Close Up just 2 weeks ago, and there was an example done by reporter Kate Lynch there, where there are reports of rents rising on a property, properties typically between $80 and $140 a week. So they've been quite sharp rents already over the past 12 months. And there's still upwards pressure for these rents to go up over the next 12 months.
But it's different in different areas. What are you seeing in some of the outer suburbs?
Like where I invest, for example, in West Auckland, the rents are going up, but they're not going up by anything like that level because simply there isn't the wage inflation to support that, and it is important for those affordability considerations as well. So it's very much charging a market price, and that means that in areas like West Auckland, where I invest, Massey, West Harbour, Henderson, Kelston, it's more like $20 a week. The rent increases that I'm expecting over the next 6 months or so.
So why are rents going up more in the central suburbs?
Basically, it comes down to the fact that these people have got tax cuts from the 1st of October of 2010. Tax cuts have been a factor that's been able to mean more disposable income. It'd be fair to say that a lot of people in these areas that want to rent in Grey Lynn, Ponsonby, Parnell, I guess Takapuna, Milford, Devonport and the eastern suburbs, the Kohimarumas, St Heliers of this world, they do have higher incomes. Often they might be in banking, financial sector jobs, businesses, and they do get higher wage increases than, for example, those in Kelston.
And so what are you seeing then in terms of activity from migrants, from people in Christchurch? How is that affecting the rental market in Auckland?
Sure. Knowing from the Auckland Property Investors Association membership, there have been a number of people that have come up from Christchurch, unfortunately, after the devastating effects of the earthquake. Whether that's going to be permanent or not, I can only speculate, but I don't think it is going to be permanent. That does indeed put some pressures on because it's more demand, there's no extra supply. The issue also comes from the long population phenomenon. It's the northward drift effect into the big smoke, I guess. Auckland still is the country's economic hub, so that does help out in terms of providing demand there. And unfortunately, the way that the council rules are and not making land any easier to get, the cost increases, means that there's a lot of pressure for rents to go up.
And what are you seeing from April 1 with the changes in the tax rules around LAQCs and depreciation? How is that going to affect the rental property market?
I personally don't think that that's a very smart move from the government. I don't think that they actually foresaw the impacts on the rents, and the tax working group didn't factor that into their equation on any of the options that they considered about the impact on tenants, because the New Zealand Property Investors Federation, who we're affiliated to, we did a survey throughout all of our networks throughout the whole country, and $46 per week was the average loss in cash flow. So in effect, it's been an indirect government subsidy on landlords being able to claim depreciation on building structure. And it's not just that as well. Just before the 20 May 2010 budget came out, the Inland Revenue released an interpretation statement by the exciting name of IS 1001, and that meant that certain things like tiles and vinyl flooring were deemed to be part of the building structure, so they were fixtures, and as a result they could not be depreciated. So that combined with the loss on the building structure items, roofing, jib, and all sorts of other components that make up houses, has led to a big cost increase. Now, so $46 a week throughout New Zealand. Our thoughts from my colleagues within the Auckland Property Investors Association, and indeed my own clients with New Zealand Wealth Mentor, about $60 per week in Auckland as the cost from 1 April 2010 per property.
But you were saying earlier that one of the reasons rents are rising in Auckland is a combination of supply and demand. So supply of a lack of new houses in Auckland and demand people who have more income. But that's only for those people who have more income. When it comes to passing on those costs, surely the extra costs involved will be reflected in lower prices, rental prices, and rather than a simple pass on of the extra costs to tenants.
Absolutely, definitely hearing what you're saying in terms of passing on costs to tenants there. Unfortunately, it means that some, I guess, thinly capitalised landlords, ones that invested in 2006 and 2007 at the peak of the last property boom, they're unfortunately finding themselves often in a little bit of a pickle. They've paid too much for their property. Sometimes they would have taken advice to fix loans for 5 years, and some of them are still fixed for 5 years at 8.8% and things like that, which is a bit of a frightening scenario. Some of those landlords are forced to sell. Some people that are still being made redundant, unfortunately what gives, it means that they have to sell the properties as well. I believe that more property investors are selling rather than buying at the moment, so as a result there's a reduced supply of houses. I personally don't think that there's such an issue in terms of affordability. I think that's actually quite a good time to buy houses as well, so I know that from some of my own tenants as well. I've got 11 tenancies, and a couple of tenants have recently given me notice that they're going to buy their own houses, which is great.
But isn't that the issue? If people aren't renting, you've got a homeowner who comes in, and if there is a reduction in price because of the change in the rules, isn't that a good thing?
Could arguably be said to be a good thing. However, it's not necessarily a good thing overall, because some people cannot get their own houses. They don't have enough deposit together. They've got bad credit, and banks don't want to lend to people with bad credit. I think it was the Vader Advantage CEO, what's his name, Mr. Roberts, stated that nearly a quarter of the country actually had bad credit, and been to bank functions with ANZ Bank and found out that a number of people have sufficiently bad credit that they all won't be entitled to get a loan for a while. So there's always going to be a portion of people that can't qualify for a loan, and also that's where landlords do provide a role in terms of the social housing needs. Who's going to house some of the country's most vulnerable people when we're borrowing well over $300 million each and every week? Don't know how much funds we've actually got to pour into Housing New Zealand.
What do you think, though, about the fundamental valuation of housing, and whether it was pumped up by too much credit going in, and whether the actual housing value had to be knocked back to something more reasonable, and the government's moves are one way to do it?
I think that it was too easy to get credit. I mean, things like those liars loans or ninja loans, no income, no jobs, no assets, I don't think they were a great thing in the market, where Bob from down the street can sign off, yes, I earn 400,000, and then they got themselves into a lot of trouble when the market turned. Fortunately, we didn't have them at 100% like our colleagues in the United Kingdom, Spain and the USA had. However, still a lot of damage was done by that. And it would be fair to say that the previous boom, arguably from the very start of 2003 towards the end of 2007, property prices did overstretch. They went up too high and the bubble burst. And 2008 was, I believe, the largest single negative equity year in New Zealand housing price history. In terms of what we have to look at is the real prices and the nominal prices being inflation adjusted. And it's no secret that the housing market is actually still in a downturn. I'm not forecasting actually any capital growth in the next couple of years personally myself, despite what colleagues and real estate agents might be telling me.
Do you think that landlords should be running their businesses for cash or for capital gains?
I think they should be running them for both. I believe firmly that investors should be investing for cash flow, equity and growth, and they need to have a combination of all three to get them through. Cash flow is just so important, because if you don't have cash flow in your business, how are you going to be able to pay the loans? We have to realise that we're at emergency low interest rates. The rates are at 40-year lows at present, so there's really only one direction for them, and that's up. I tried plotting out the average floating 1 year, 2 year, 3 year, 4 year and 5 year rates, taking them back over 10 years, pretty much when I started investing, and I believe it's around 7.75% is the weighted average 10-year rate across those categories. Does that sound a relatively reasonable figure? So if you can get 2 years fixed at 6.4%, I think it's a bit disingenuous doing your numbers on those kind of figures. So I would obviously urge investors and indeed homeowners to urge and exercise a bit of caution, and realise that as time goes on, interest rates will go up, and they potentially might go up quite sharply.
And the practice that some have done of making losses on their rental property and then claiming it against their personal income. What's your view on that as a practice?
I've done that myself in the past, and I did that starting up when I was working at Russell McVeigh. I had quite a high salary, and as a result I was able to use a loss attributing qualifying company, or LAQC, like probably a couple of hundred other thousand investors, to do that and get the taxes down. It meant for me that I paid a greatly reduced tax rate. However, that has become a lot harder to do now, and whilst I think it has been nice to do, the party is somewhat over in that sense. I just am worried about a bit of a flow-on effect in some areas, because some landlords are trying to pass that on in rent increases, because we've been facing increased costs with rates up 4.9% in Auckland, increased costs with insurance as well after the September 4th 2010 earthquake. GST actually does have a cost on us too. Under Section 14 of the GST Act, residential rents are exempt from GST, so we cannot charge the GST on rents, but we have to pay them on rates, on repairs and maintenance and insurance charges. So there have been some costs that have flown on through to landlords as well. So I believe that that's why some landlords are exiting, and that's what's actually putting a little bit of pressure on house prices as well, because it is the market forces the supply and demand balance at the end of the day.
Great. David Whitburn there, the president of the Auckland Property Investors Association, talking about rental property in Auckland and elsewhere. I'm Bernard Hickey. That was another in our series of Double Shot interviews.